All right, let's talk more about the latest on the regional banking turmoil and what is next for NYCB, as well as this broader concern. We want to bring in Dave Mazza, Roundhill Investments Chief Strategy Officer, here with us in studio. Dave, good to see you.
Good to see you as well.
So I note today that bank stocks, or at least financials broadly, are not down, right? It is, and NYCB itself is now rebounding. Yes. So how are you sort of thinking about that broader CRE risk, commercial real estate risk, and whether it is a larger problem?
Well, first and foremost, anytime you see another bank under pressure, it gets the hairs on your skin rising up, right? Because we've been through this drill before. Everyone goes back to '08 and what happened with the big banks, and it's not just one. And then we had almost a year ago today, banks that were generally considered to be high quality, well run, had strong exposures, going under. And here we are again, almost a year later, with a bank that acquired some of the assets of one of those banks under pressure. So it really gets you thinking, is commercial real estate gonna have this contagion risk? But what's interesting and been fascinating to me is people have talked about this concept of a rolling recession. I think CRE is a great example of that. It's just the marketplace kind of has been picking its spots and saying, we're going to go after this area, right? Tech was the first place, right? And crypto and the exposures that banks like Signature and Silicon Valley Bank had to that. But here, what's a bit more concerning to me about NYCB is the fact of all the multifamily loans that it has in the New York area, the largest market for multifamily loans, and what that could mean should the bank actually face further pressure.
So you used to be suggesting, Dave, if you're a viewer right now and you're invested in regional banks, you think there is reason for some concern here?
Certainly. I think some people have been trying to focus on buying the dip in regional banks, and there certainly could have been an opportunity. NYCB was actually one of the better known or well-liked banks because of their strong dividend. And many of the buyers turn into sellers, right? If they're not going to pay you that dividend, they're going to exit right away. What's interesting, though, is that to me, it's hard to say, like a wildfire, that this is not just a spark that's gonna go away. What the concern is, does this then flame into other areas? Ultimately, I think because of the stresses in the system and the lack of wanting for it to be real stress, something will happen here. The chairman, of course, the new chairman, I should say, moving from non-executive to executive.
At NYCB.
Exactly, to be clear there, could settle down the name. But what we've learned is once the short sellers and investors turn on these regional banks, they don't have a lot of patience. So that would be my concern for someone who's looking to invest in the space right now.
Okay, so let's talk beyond the space then, because if you're concerned about spillover, does that mean you as an investor stay away not just from regional banks, but from big banks? I mean, in the past situation last spring, the thinking was that big banks would actually benefit. I don't know if that's still the case with the commercial real estate exposure. Do you stay away from REITs, particularly multifamily and/or office REITs? Do you stay away from companies that offer credit to these, that are in that space? Like, how far does it go and what do you watch?
Well, I think it's sort of an interesting point. Ultimately, probably a large bank will end up acquiring these assets. Now, that's not a prediction. I don't cover the stock from a fundamental perspective, but I think that's the scenario we're finding ourselves in, is that we cannot rely on having a bank, even a regional one, fail to a great extent, because we know the impact that has on real people, on depositors, of which have not been the issue in this particular case. But there is stresses. There's reports on a daily basis of large office buildings in areas like Los Angeles and other places that are selling for 50% less than they went at just a few years ago, or in some cases even lower than 50%. So it's hard to say that there's not issues with the real estate sector. REITs have been an area that I think many people have wanted to like for some time based off of the interest rate environment, but it's just not there yet. So even though rising rates in theory should help banks, this flat yield curve has done nothing but actually hurt them, and in fact has put pressure on things that are variable, like commercial loans. So the picture remains pretty murky.
Let me ask you this, just to switch gears a bit here too. Listen, earnings season rolls on, after the bell today, Disney, PayPal. Just interested to get your thoughts on what you make of earnings season so far. You've seen about 70%, I think now companies beat expectations. That is above the historical average, but what have been your big takeaways?
Yeah, earnings actually have been generally pretty good. I think investors are happy to see that we're out of the earnings recession and the slump that we saw there. But we're still in an environment environment to me that is these haves and have-nots. And that's something, a thesis that I've been talking about for some time, is that there's a select group of companies. Some of this is the Magnificent Seven, and there's others in other sectors that are winners. And then the have-nots are these losers. So for stock pickers or people looking to stay, let's take some risk and move back into areas that either had done well a few years ago. It's been challenged, and we're seeing that at earnings season. Look at the bivarication between Meta and Snap. You can choose really two companies in any sector and say who's done it right and who's done it well. And really, what investors are focusing here is on that efficiency, right? It's kind of a sad thing to say, but companies that have embarked on layoffs are actually being rewarded by the market because it's improving their profit margins and the like. So to me, it's not clear that it's all clear on the earnings side, but we are seeing some companies really put up some strong numbers.
Yeah, although Snap is one that's cutting, and it's maybe the market thinks it's not cutting enough. Yeah. We've been sort of playing a fun parlor game that seems to be happening in the market right now, which is the Magnificent Seven still the Magnificent Seven, and what's the new FANG or Mag 7 or whatever you want to call it, or is it still just the Mag 7?
Yeah, it's interesting. So it was FANG, then FANGM, and then more recently Magnificent Seven. Now we're hearing Sensational Six, or keeping
Dynamic Duo. I've heard that one. Yeah.
Right. It's like now people are saying keep the Magnificent Seven because we kind of like it, and then maybe swap out Tesla. But what's fascinating to me is I actually went back and looked through time. Magnificent Seven as a term didn't exist in 2013, but I went back to Meta's IPO to measure this. And if you look at the divergence, the average range between the best performing and the worst performing name out of the Magnificent Seven, there are some years where it's over, on a rolling 12-month basis, over 1,000%. Now, some of that is Tesla's outsized gains, but also remember, Meta was in a huge slump for some time. There's been times where people have counted out Apple. So I'm not ready to give up at all on the Magnificent Seven, even including Tesla. Of course, time will tell. But these companies, on average, at least compared to the other 493, are showing high top-line revenue growth, high strong margin growth, and in a market has this uncertainty, whether it's from commercial real estate or other areas, that's where investors are saying, hey, it's not so bad where I want to sell stocks, but if I'm going to buy, I'm going to stick to the mega caps.
Yeah. They said, a lot of these names too, Dave, of course, part of the reason you've seen these stocks jumps is because they put so much time and effort and money into AI, integrating the tech across their portfolio. And you can see some of them, like Meta, really benefiting from that technology. And we have bulls on the show say, listen, this is the year you're really going to see use cases and monetization ramp. You buy that? And if so, what do you think are the smart ways to play that kind of broad secular theme?
Yeah, no, I would totally agree with that AI is actually here and now, right? A lot of times when it's thematic investing or other trends in the market, folks are looking at things that could happen 5, 10, 20 years in the future, but we're already seeing it, right? Companies like Salesforce and ServiceNow are integrating AI, which is often powered by cloud-based services from Microsoft and Alphabet and others to allow that to be more efficient for employees and for corporations. So as companies realize the benefits of AI, right, that's not just fun playing around ChatGPT, even though I like to use it myself, or other things of that nature, it can really be that co-pilot for employees to make them more productive. So to me, yeah, this remains the year of AI integration and the actual use cases. I think Microsoft's earnings were a good example of that. And even Meta, who's been plowing money into something like the metaverse, and there's questions about will that actually pay off? Well, those investments are starting to pay off in AI. Those are the enablers for a lot of this to happen.
Is that the dynamic duo, by the way, Meta and Microsoft?
I think the dynamic duo was referring to the two that had positive stock reactions after the prints. I think it was Amazon and Meta.
Okay.
Yeah, dynamic duo. Either way, it's catchy. I mean, it's fun.
All of the stuff is.
Oh, yeah. Dave, thank you so much for your time today. I really appreciate the insight.